I have a friend who's a lifelong Raiders fan, who grew up in the 60s and 70s and 80s rooting for the Raiders and Al Davis and Kenny Stabler, you name it. And one by one, the ownership changes, the key players leave or retire, the team moves to Las Vegas. It's like, and now he's like, why he's not, I said, I'm not a Raiders fan anymore because there's no Raiders there as I know them to root for.
Yeah.
So he feels a little disjointed.
Welcome, everyone. We'll give everybody just another few seconds to log in and we'll go ahead and get started. So,
yeah.
And Chris, I don't know how every time you're on, it seems like it's just on the heels of Michigan whooping my Buckeyes ass. I've really, my scheduling calendar, I've got to really work on that. So, but
you have a longer memory than that. I did actually wear your favorite shirt.
I know. I've seen it far too many times on this show. Yeah.
I have one that's a very bright maize, or I guess you probably could call it highlight or yellow, but I decided to spare you and leave that one at home for today.
Thank you. But congratulations on yet the fourth straight beatdown of our Buckeyes. Just we tried to play your tough man game and just got beat at it, and we just couldn't do anything. It was really a team that's just gone up and down the field all year. It was, against the Michigan team that at times this year has looked like not very good at all.
Here's the funny thing, right? We have a huge upset victory, and 2 days later we fire our offensive coordinator apparently because we didn't win by enough. I'm not really sure what that is, but it's a funny game sometimes, right? We're very lucky to come away with that one. It's got some of the cards to line up for us, that's for sure. I think we caught you guys on an off day.
Oh man, it's just yeah.
Seen a lot of comments in the chat of people that want me to put some masking tape over the M here. I got a lot of friends in Ohio, so I'm gonna take a little bit of grief for that probably.
It was John B from Van Dyke. He's Justin Messer from Prosperity. He's a big Michigan fan. I was, he was reverse jinxing me all week on email. Just like, dude, as long as we keep it within 30, it's a win. I'm like, stop with your reverse jinx. So,
all right.
Once again, the Wolverines get it done. So, congrats, Chris. So,
did you go to the game?
I did not go to the game. I went to the Indiana game the week before. So, thankfully, because I was killing myself that morning as my son's texting me tailgate pictures. He's a sophomore at Ohio State. And then, then I texted him as there was a full-blown brawl on the field at about 3:10 p.m. Maybe it was a good idea I didn't come down. So
there was some blood spilled.
Well, welcome, everyone. This is The Big Picture. I'm Rich Swerbinsky with Onward and Upward Consulting. Thank you for joining us. And as always, pleased to be joined by my esteemed colleague and co-host, Rob Chrisman. Rob, good to see you.
Good to see you.
Festive background there. Very, what are you, in a bar?
The bar in Mexico,
much.
Right?
Yeah.
Pretty much.
All right. And this week, very, very pleased to welcome back to the show. This is how you know we love Chris, when we're very, very pleased to see him after Michigan just beat Ohio State 4 times in a row. But he is our go-to guy on all things capital markets, secondary markets, mortgage rates. He started Vice Capital 25 years, has it been?
Just about, yeah. It'll be 25 next year.
25 years, Vice Capital Markets. And this is not a sponsorship. This is just me. Anybody that wants a great edge advisory company, this was the firm that I used throughout my capital market days. They were a great partner of ours at TMC. Great people, great expertise, and just an incredible company for a quarter century. It seems kind of crazy, Chris. It's our buddy, Chris Bennett. Chris,
I can't be nearly that old, can I? Hey, always really appreciate it, Rich. Thanks so much, man. I really am not that old. I've been dyeing my hair silver for probably about 20 years, just so I can people respect you more if you look older. So that's why I tried to do that.
I like that.
I'm only 32, actually.
It's a slick move, and Chris had a pretty accomplished secondary career, adding further to whatever his age is. And that's one of the things I liked about Vice is he sat in the seat and has stayed incredibly and intimately involved in just really all aspects of the company, and just somebody you could pick up the phone and talk to. for counsel if you're a client of theirs, or if not even. So Chris, welcome to the show, and excited for the conversation today.
Yeah, overly kind, Rich. Thanks so much, man. It's actually it's nice to be in an environment where there's lots of exciting things happening, right? There's lots of times over the last 20 odd years in bond land that are they're boring, right? Fed funds rates at a certain level, it's not moving. Economic numbers don't matter. Now they all matter, right? It's there's a lot of fun stuff going on now. So it's a great time to be in the markets and to be in the mortgage biz.
I
Maybe
love
not
it.
a great time, but an exciting time.
I was gonna say it's, a little bit of putting lipstick on a pig there, but yeah, it is certainly more exciting than it has been, and all the numbers matter, and certainly it's got everybody's attention 3 years into this kind of high rate market. So there we have it. But so Rob, where do we start this week? We got a big jobs report tomorrow. It's been actually positive. Inventory's up a little bit. Rates have come down a little bit. Purchase activity's up a little bit as we get into December. Some mildly positive signs. You got Rohit Chopra going out like Tony Montana at the end of Scarface, just firing Uzi spray all over the industry. His last days at CFPB. We got a new Treasury Secretary nominee. We got a new presidential administration coming in. What anything in there that gets you excited, Rob?
Well, sure, all of it or none of it, depending on what you want to talk about. Certainly with the election of the Trump administration and everything that's been going along with it over the last several weeks, the financial community has a lot to talk about. But I think that it boils down to the regulatory environment and the interest rate environment. And certainly Trump can set the regulatory tone and is already doing that. But I will continue to make the argument that no president, or the Federal Reserve for that matter, can set interest rates per se, especially mortgage rates. It's supply and demand. And right after the election, I made a comment about how it appears that the lenders out there, residential lenders out there, will have less business, but fewer regulations governing that business, and that appears to be the case with, as you point out, certainly the potential change at the head of the CFPB in a month and a half. So we can talk about that for a month and a half, and I think that people are pretty much taking for granted that Trump's nominees will get ushered in, even though they are, in fact, many of them nominees. And so that'll be interesting to see. But certainly the regulatory environment will lessen. Kathy Craniger, who I think did a very good job under Trump in terms of running the CFPB. I haven't, her name has not come up, nor is Mark Calabria's really that I've seen officially. So, new folks coming in, great on the regulatory side. But on the interest rate side, many of the policies, and I'm sure Chris is going to talk about this, but people have to think about, the people have to take a breath, think about who's going to pay for tariffs and what will that do to the economy? What will it do to interest rates? And what will it do to what will those tariffs do to mortgage rates? But also just the general tone of the environment. And, as every president ever elected wants lower rates. But the fact of the matter is the Federal Reserve is independent and is charged with maintaining the stability of the United States economy. And sometimes that's difficult to do depending on the administration. And if you have a president that is talking about firing you, sometimes it makes it tough to do your job, So we'll see what happens. Chris, what are your thoughts?
I love Chairman Powell's response when he's asked, had President Trump, President-elect Trump ask you to step down, will you? And he immediately said, no. I said, well, what if he relieves you of your duties? And he said, the law doesn't allow that. So he nipped that right in the bud, which I'm glad about. That's not a thing. While still, he was, I think it was a talk a day or two ago where Chairman Powell said, we're looking forward to, we think we'll have a good relationship with the Trump administration, just like we did with the previous Trump administration and the current Biden administration. We're here to do our jobs. Fed independence is certainly very important, certainly to the Fed, but really to most thinking people. There's a lot of things that get said in campaign speeches. There's, President Trump is kind of a gunslinger. That's probably an understatement. So a lot of these things that are proposed or that he'd like to do, they require congressional action. And some of that's actually filibuster proof. It actually takes 60 votes in the Senate to be able to do some of these things. Tariffs actually are one of them. So president sets policy. The Treasury Secretary, which Scott Bessent is a nominee, I think, like we saw in the markets, right? The bond market liked it immediately. The stock market liked it. It was kind of, after a number of the nominees that had come up there in the first week or two, a lot of us were kind of worried that the My Pillow guy might get nominated for Treasury Secretary. So
I think after Matt Gaetz, it was like, the markets, once they heard Bessent, it was like, oh, all right,
Yeah. Have a collective sigh of relief of, nice to have a respected adult in the room. And a lot of that, role is an advisory. It's somebody who gets it. And yeah, billionaire hedge fund manager, but a lot of the smartest people with those kinds of things happen to be hedge fund managers and or billionaires. You're not going to name Elizabeth Warren probably the Treasury Secretary, so it's okay that the person's got those kind of credentials. It definitely was seen as a good move, that's for sure.
And our friend Bob Niemi notes in the chat, Kathy Kraninger now the president and CEO of the Florida Bankers Association. So she landed in a nice spot, and but we'll see. CFPB, probably not till the new year till we get nominees. I'm trying to remember the timeline from.
Yeah, it's going to be farther out than that, and that is definitely, I shouldn't say definitely, Donald Trump has pulled off some things before, which people raise eyebrows. Supposedly, the CFPB director goes through a nomination process and a ratification process. It could take some months. It's not a wave your magic wand kind of post. But whoever's going into that will definitely be it could be it'll be a Trump loyalist. I mean, that's almost guaranteed. I mean, he won the election, so good for him to put somebody in. And I think the mortgage banking world could use someone like that, although banks and mortgage banks and so forth have proven, I think, time and time again, they can't really regulate themselves. And certainly the industry doesn't want to pull back necessarily. Well, maybe it does. I don't know. Maybe I'm reading it wrong, but I've received emails since the election. Well, when is TRID going to go away? And I say, well, you know what? The industry has spent tens and hundreds of millions, I don't know how many millions of dollars adhering to TRID and adopting those rules and regulations and policies and procedures. And to eliminate it would be not good for the industry. So,
yeah, and I mean, as many Rohit Chopra jokes as I make, deleting the CFPB would be horrible for our industry, in my opinion. I mean, it's just for the small to medium-sized independent mortgage banker, or the community bank that's out there struggling to compete. The biggest national IMBs are the ones that play on the edges, and I think it's important to have something in there, but we'll see how that all plays out. So
yeah, if you're a large lender, obviously you're dealing with not only the CFPB, but you're dealing with Fannie and Freddie and HUD and various states regulatory bodies, which, and I'm just touching the surface of the entities that companies have to deal with, that are oftentimes camped out in their office for weeks or months at a time, going through the audit process. And we don't need, I think some states have shown a preponderance to ramp up their regulatory environment if the CFPB scales back. And I think large lenders don't necessarily want to deal with many CFPBs in places like Illinois or New York or California. Should the CFPB do some, scale way back. So we'll see.
Getting to the rate climate, Chris. So we've had a little relief on 30-year fixed rates, then probably like the 6, 7-ish range right now. And like here's my theory is I think there's a lot of there, and I would encourage you to debunk this because I don't think this is conventional wisdom. There's a lot of fear built into the bond markets right now. Because again, Trump won, and two of his main, kind of campaign platform policies, mass deportation and tariffs, both incredibly inflationary. At the end of the day, probably, there's going to be things done in those arenas. But like Biden raised tariffs on China very aggressively in the spring.
Yep.
And, so, my general sense is that it's more saber rattling and leverage in negotiations. And, if indeed I am right, and the inflationary fears in and around deportations and tariff imposing don't play out, that would reflect itself in the bond market. And, and if that does play out that way, we could see rates lower than all the economists are projecting.
Yeah, I think so. I think so too. It's I agree with you, Rich, and I think it's really interesting. And this is the nature of all markets, not just the bond market, stock market, corn, wheat, whatever it is. You've got these fights between bulls and bears, and you also have a case where I don't want to use the media as a term because that's not what I'm trying to say at all. But sentiment toward a market shifts this way, it shifts that way, and it builds upon itself. We had a case. I don't know, maybe it was 3 months ago, the 10-year yield is down at 370, and people were talking about how it's headed for 3%, and mortgage rates are heading another percent lower. Now we have a case, the 10-year yield goes back up to 4.5%, and now everybody I see on Bloomberg television talk about how we're on our way to 5%. So the market has a tendency to really overswing in one direction, overswing in the other direction. That's the nature of how markets work. And you're right, especially in this case, it gets called the Trump trade, right? The last time the Fed, which actually was just after the last time that you guys had me on the show, the last time that the Fed put out the dot plots, every other Fed meeting, so once every 3 months, they put out their summary of economic projections that says, here's what we think about GDP for the next several years. Here's what we think about the unemployment rate. Here's what we think about inflation. Here's what we think the Fed funds rate will be. And it's a great predictor of at least, here's what this entity that has 140 economists with PhDs on their staffs and all the information in the world think about what's going to happen. And so when you took a look at what they thought about just short of 3 months ago, their expectation was about 75 basis points of cuts in 2024, 100 basis points of 2025, and 50 basis points in 2026, which was in the aggregate the same amount that they had predicted the last time, or projected rather, not predicted, projected in the month of June. But they took 2 of those cuts from 2026 and moved them up to 2024. We had that supersized cut of 50 basis points where the Fed kind of said, hey, if we knew back then in July what we knew now, we would have cut back then. And so what I find really fascinating is you look at what the Fed thought at the last time they put out the dot plots, and you look at what the market has done in just 2.5 months since then. It's been a huge paradigm shift. And it's not like we suddenly went from Trump 0% winning to Trump 100% winning. That number was always kind of 50% or a little bit higher than 50%. His policies are things that have been known or projected or desired policies. But the market suddenly has decided that this long-term Fed funds rate is going to be higher, that inflation, the risk is it's going to be higher. All these things, we suddenly added literally almost 100 basis points. The market did anyway, not the Fed. The market did to those longer-term expectations. When you look at what the market now expects for Fed funds at the end of 2025 compared to what it thought 2.5 months ago, they're almost 100 basis points different in level. And one thing that's even more interesting than that, in my opinion anyway, when you look at projections for SOFR, what used to be LIBOR, but now SOFR. So essentially the Fed funds rate every day out going to, we can actually do SOFR futures out to at least 2029 right now. There's been a huge shift in what that long-term expectation is. When you look at 2026, 27, 28, 29, the market's expectation 2.5 months ago was for about 280 on that rate. It's now 370. We've literally shifted up these long range expectations by 3/4 of a percentage point. And maybe that bears out, maybe it doesn't. That's a huge paradigm shift. There's a term that economists use called R star. Not to, I promise I'm not using any Greek letters whatsoever, but this is R star. It's a big R with an asterisk next to it. And what that is, it's the long run neutral Fed funds rate that allows you to have full employment and stable low inflation. It's kind of like, here's the Goldilocks rate that is neither restrictive by being too high or overly accommodated by being too low. And the market's expectation of what that is literally shifted up by almost a full percentage point in a span of 2.5 months. It's a dramatic seismic shift. And I agree with you that I think the market's reacted too much to this. There's a lot of things that happen to have, whether it's through excessive tariffs, to have these inflationary things. You can't just take however many million undocumented migrants we have here and flip a switch and write a check and all that goes away. That just isn't how that works. So I think those fears are a little overblown, but the market certainly reacted to it. It's reacted really, really swiftly. It's been surprising to my mind that it's happened that quickly.
Well, there's oftentimes, Chris, as you know, collectively, if you go back and think about the Titans, I'm going to put on my philosophical hat here a little bit. So, Chris, I'm sure you'll appreciate this. But if you go back to, Jay Gould or the Rockefellers or Carnegie or the captains of industry who have created environments, market environments or interest rate environments, stock environments, or whatever, there's wisdom. They're pensive. They have a plan. They move forward. They don't tend to have knee-jerk reactions. But so many markets now, so many players in those markets have these knee-jerk reactions to whatever news comes up, that the markets tend to swing and then they head back, and then they'll swing some other way, then they'll head back. It's that knee-jerk reaction. There's not a lot of wisdom in some of the market activity that goes on now. The interest rate environment, nobody, we as an industry, the people on this call, we kind of look at we react to whatever the environment is. Maybe you're a public relations firm, or maybe you work for an environmental consulting firm, or maybe you work for a title company, or maybe you're a loan officer. And so you just have to keep your knees bent with these swings and try to maintain an even keel for your clients to rely on you for, public relations services or environmental consulting or title work or whatever it is, regardless of what interest rates do. And so I think that the swings are difficult for people to deal with on a day-to-day basis. And a lot of people, I think, benefit from knowing why the market is doing what it's doing. But I continue, and Rich has heard me beat this drum, hundreds of times. The good loan officers and the good lenders and the good vendors say, okay, well, interest rates are doing what they're doing, but I need to help my client. And so let me figure out a way to help my client, or let me figure out a way to help my borrower, regardless of what's going on with the market.
Yep. I agree 100%. We're not going to have this giant rise or giant dip that's going to fundamentally change everything, right? A lot of what we're doing is just the same thing we do every day.
Right.
And the Fed, Chris, Jay Powell yesterday, really was pumping up the economy, talking about the strength of the economy, while noting, kind of persistent inflation that's just kind of lingering around. Of course, their last meeting of the year coming up, December 17th and 18th, cut by a quarter.
I think it's more likely than not. I think, the two big things we have between now and then are non-farm payroll tomorrow.
Mm-hmm.
It's interesting how big of a, last month, there's a lot of people don't know, there's a report called the ADP that comes out 2 days before non-farm payroll. ADP, the biggest payroll provider, says, here's what we think, here's what we show for payroll growth. And a decent amount of time those are correlated. They've not been very well correlated at all. They thought 280,000, jobs from the prior month, and then the real non-farm payroll number comes in at negative 28,000. a lot of hurricane distortion, right? And the market kind of wrote it off a little bit. But I think that'll be a big one. Do we have a rebound there jobs wise? The job market really is strong. Even though unemployment's ticked up, it's ticked up from such a low level. That's not a level that should cause any sort of recessionary type issues. And the other, of course, being CPI that we'll get before the meeting as well. It seems like that when it comes to fighting inflation, all the metrics have come down so much, and our other G7 partners in the world too. But it's that last mile that's been so hard to attain, hasn't it? So it's a case where the Fed's happy to remove being overly restrictive, but it's not going to come anywhere close to accommodative. Maybe not even going to come very close to neutral until we can really get that to kind of come down a little bit more.
Yeah, I don't think the economy needs it.
Yeah, it doesn't, right?
Rich has heard me beat this drum hundreds of times. When was the last time the middle seat in an airplane was empty?
Yep.
When was the last time you found a parking place at the airport near the front door? And a lot of people may not change their behavior, even if they did know or even have benefited from a Trump trade. Chris, just so you know, and I know this for a fact, maybe, Rich sank his entire life savings into Bitcoin before the election, and he's profited handsomely. Rich has not changed his wardrobe one iota, nor has he changed his background, despite being the latest Bitcoin billionaire. So,
man of the people, consistency. Yeah,
that's right. That's right.
So, I wish I had invested in Bitcoin. It's going wild right now, but yeah, well, it's going to be interesting to see how that all plays out. And as Chris, that we got some big numbers coming up. Of course, tomorrow morning, the November jobs report, and then CPI. That's still. Do we get CPI and PPI before the Fed meeting?
CPI for sure. PPI, I don't know if that comes out before or not. They're usually 2 days apart. I know it's in the Fed's quiet period too. Yeah. Also, not to be forgotten, tomorrow at 10 o'clock, there's another big number. University of Michigan Sentiment Index, which is estimated to be sky high after Saturday's victory in Columbus.
I should have anticipated that was coming, but and
that
is a real index, yeah, for those that may just think Chris is busting my balls. But
it is a real index. And actually, when I went to the University of Michigan a few years ago, one of my professors actually was one of the 3 professors who ran the Michigan econometric model that produces all these. Consumer sentiment's a big thing, and then inflation expectations are a big part of this release that comes out once a month, especially during these times where we've been very worried about inflation expectations becoming unanchored. The actual surveys and the sentiment about what people and businesses think about long-run inflation actually matters quite a bit more.
Wow, and that professor's still alive. Wow.
I mean, I'm not sure if that professor's still alive anymore.
What else, Chris? You obviously operate one of the industry's leading hedge advisory firms. Anything else just you're seeing your day to day with your clients in terms of trends?
Yeah,
there's you're talking about.
Yeah, a few things that one thing that I think is kind of neat and of noteworthy that so we just finished up the month of November, and we're always paying attention to mortgage-backed security issuance, and we actually had, for the first time, we have 4 months in a row where collectively as an industry, we've made more than $100 billion of mortgage-backed securities each month. And in fact, last month in November, I can't remember the exact number, but it was the highest we'd had in 27 months. So even though those are coming from very low levels compared to the big party times in 2020 and 21 and the start of 22, things have gotten better there. Another interesting thing is, because a lot of people have the idea that there's no refinances out there. There was a couple 3 months ago, but there's none. But, the MBA reports on it all the time. And even right now, even after interest rates have backed up, 39% of all applications are refinances. 3 months ago, it was 55% we spiked to. So now that's units, not dollar amounts, because refinances on average are smaller. But it's interesting. It's kind of, I tell folks that, as an originator, as a company, if you think that refinances don't exist and you're only 5 or 10%, somebody else is probably refinancing your customers, that there's a need out there and they've got, and somebody else is actually taking care of that need. And it's something that you don't want to just ignore and say, well, refinances aren't a thing. They are a thing, and somebody's going to get them. Somebody's going to help that borrower. It just might not be you.
Yeah, the people talking about the demise. Certainly the percentage of refis has gone down, but we haven't talked about credit card debt in this call, but credit card debt, I don't know, it's trillion, 1.1 trillion, 1.2 trillion, whatever it is, makes a lot of sense for many of those people to pay off 25 or 30% debt with, even if rates are 7 or 8%, still makes sense. So there are refis going on, and everybody on this call can bet their bottom dollar that the companies who have been purchasing servicing have great retention teams that are trying to keep those borrowers and try to refinance them and remind them of their interest rates that they're paying on credit card debt. So they are, refis are out there. So
they sure are. Well, hey, and we talked about changes coming with the new administration. Fannie and Freddie conservatorship, right? That's got to be a hot topic right now. What do you guys think about it? Actually, if you look at Fannie and Freddie stock price, right, since the day before the election, it went up 150%. And then in about 2 weeks, retraced about 70% of that. So, and those just trade on the pink sheets, the old, I guess pink sheets. They're they're not traded on the big exchanges. What do you guys think about that? So the market certainly is thinking, if not that it's some sort of meme stock, but we've seen Fannie and Freddie hoard. I mean, make gigantic profits. They're keeping it all. They're recapitalizing. As you reported on a number of times, Rob, in your newsletter, G fees that they've been charging have gone up about 6 basis points in a 6-month period. And when you ask them about it, they just say, yeah, we're trying to stockpile and rebuild our capital for a time when we might come out of under conservatorship. And yeah, that's what we're doing. We're going to build more capital by increasing our guarantee fees. How big of a change? A lot of things got laid out, but Donald Trump was president and went in control for 4 years, and nothing happened there other than it was talked about a lot. What's going to be different this time, or do you think it's not different this time?
Well, obviously during the previous Trump administration, the recapitalization began, right? They started being able to keep their profits, and so their net worth, I think Fannie has a net worth of 90 billion, and Freddie Mac, I think about 56 billion, and Fannie Mae and Freddie Mac certainly are not in business for their health, and it's arguable. Sorry, I apologize to people from Fannie Mae or Freddie Mac on this call, but it's arguable whether they're in business for the health of their clients, and so they do have an eye. They're not allowed really to talk about the future, but that doesn't stop us from conjecturing about it. And the fact is, Trump would like to see them at some point released from conservatorship, but we've reminded people time and time again, it's not Donald Trump flipping a switch on the wall and suddenly they're on their own. It's a very complicated issue to the process of setting them down that path. And just the basics. What do you do about all the securities, the reps and warrants and so forth? Somebody, the Korean money manager who bought $500 million of Fannie Freddie securities 3 years ago. What happens if those loans go bad? Who is that money manager going to go back to? Who's going to stand behind those loans in securities that were issued during conservatorship if they are released from conservatorship? And certainly the arrangement that the agencies have with the Treasury Department and some of the options, the warrants and so forth. I mean, it's a very, very complicated issue. So it's gonna take, it could be the crowning achievement of the Trump administration to get them released at some point. And then the big question is, if it's done incorrectly, or even if it's done correctly, what is that going to do to the good old Fannie Freddie, pass-through rate? Who's going to stand behind that? How much net worth do they need in order to make the market comfortable that money manager in Korea who's buying a mortgage-backed security has the Fannie Mae and Freddie Mac have the wherewithal to stand behind those securities if something goes bad? You certainly don't want to have to go back to the government if things go bad and say, hey, can you bail us out again? That would be disastrous. But generally, Chris, I'm hearing 30-year rates, they're not going to go up to the non-QM level of interest rates, but it's not as if releasing them from conservatorship is going to cause Fannie Mae and Freddie Mac's rates to go down. So I'm hearing, 1 to 2% higher, possibly. And that's just really, thumb of, just a number.
Yeah, it's interesting because I've heard that from a number of folks too. I kind of have the opposite tack on it. Actually, I dusted off. I dusted off this. I printed off right here. This is a white paper that NBA wrote. They starting 2016, right? They had a task force that worked for a year on providing a guide to here's what we think the post-conservatorship world should look like. It's 59 pages, and as soon as I printed it, I'm like, oh wow, 59 pages. But even before the existence of ChatGPT, they have a lovely executive summary of 5 pages, which I did read, dusted off. And I think I think they've actually put together a great framework. One of the big things that they talk about is, capitalization. And one of them is bringing in, not just having it be Fannie Mae and Freddie Mac, but we have this new UMBS structure, right? That Fannie and Freddie can both guarantee securities into this uniform mortgage-backed securities. It doesn't have to stop with just Fannie and Freddie. We can allow other guarantors. I don't want to name names, but let's say it's JP Morgan Chase, or it's Bank of America, or it's one of those other really big houses that could also guarantee mortgage-backed securities. And to my mind, I know kind of they're actually the Democratic the paper during the election cycle. They just called it a new path forward for middle class America. They said if the agencies are released from conservatorship, the average cost would go up by $1,200 a year. They called it like the mortgage premium that would go up by, which I don't know what they mean by mortgage premium, but mortgage premiums would go up by $1,200 a year. And I think I have the minority view on this. Actually, Chris Maloney from Bank of Oklahoma wrote a really good piece this morning. If anybody who doesn't should try to find a way to get the stuff he puts out there. It's terrific stuff. He very much thinks there's no release for conservatorship. He lists all the reasons why and all the obstacles. But to my mind, I think that if the will is there, and Donald Trump would certainly love to have his name on the biggest IPO ever in history of releasing them for conservatorship, that to be able to implement some of the things that are put in here, I think it actually would reduce cost to consumers. If Fannie and Freddie for all of the 1990s and the 2000s had guarantee fees that were between, say, 15 and 25 basis points, and for all the people on the call, which is most everybody who isn't a capital markets person, that's how much they're scraping off each of the payments every single month. That's what they get. They get compensated to guarantee principal and interest, 15 to 25 basis points. Now that number's 50 basis points, plus we have loan level price adjustments on top of it, so it's really 65. To my mind, if you have them truly competing against each other again, right now they're making tons of money. Back when they really competed against each other and weren't just kind of doing what FHFA told them they were allowed to do, guarantee fees were way lower, which meant cost to consumers and interest rates were substantially lower. So to my mind, I take the opposite tack of probably what a lot of other people do in being concerned about it. And I think that if done right, it could actually be a great benefit for the American consumer, because now we'll have.
I sense a bet. I sense a wager, Chris.
All right.
I'm
it may
with
take
Chris.
3 or 4 years for one of us to pay off the other, but I'm with you.
I've changed my tune on this over the last several months, and I agree. I think they'll be released from conservatorship. You don't need Congress to do it. It is, FHFA's responsibility and mandate is to release them from conservatorship. And you've mentioned all the fees. I think guarantee fees are even higher than what you mentioned. Delivery fees are excessive. And there's other things that could mitigate it too. When we were talking to Mark Calabria, he said they had a whole plan. He said that there isn't even a government guarantee. It's an implicit guarantee. It's not guaranteed. He said that the market interprets like a 60% chance of the government actually. So it's not 100% guarantee that you have to essentially price. And he said it's about 60%. And he said that if you built a capital stack, kind of alongside, the MBS infrastructure, he said if you just at the very edges of the most risky credit, just, tamped it down a little bit. And then, he said there were other factors too. He anticipated 10 to 35 maybe basis point increase in rates, if at all. And he said also, the Fed could also come back in as a buyer of mortgage-backed securities. They've been out of that game, to help the transition. There can be other guarantors JP Morgan Chase, like you mentioned. And I think there's a lot of other factors as well that, because right now, I mean, Fannie and Freddie are just getting rich off American home buyers. They're lopping 60 to 70 basis points in rate on every mortgage. Every single mortgagee in America that goes to Fannie and Freddie, they have 50 to, depending on whose math you look at, 65 basis points of that rate and interest is going to Fannie and Freddie to recapitalize them. They're going to be recapitalized enough in, like, by most projections, a year or two. So let's get it done. I mean, I'm sick of the GSEs. It's so political anymore with them. Depending on who's in office, their whole MO changes. But the one thing that doesn't change is the cost of the consumer keeps going up and up and up as we're in the biggest affordable housing crisis, at least in my lifetime. I mean, nobody's talking about it. It's crazy to me.
All right, so
Absolutely right.
let me get this straight.
You may have a two-way bet, Rob.
I can
The Nolan Ryan rookie card, Rob. That's what you're putting up. All right.
No, that's off the table. But so, Rich, what you're echoing what Mark Calabria said about rates may be 10 to 30 basis points higher than where they are now, all things equal. Chris, you're saying rates may actually go down. And are you basing this, say, on a spread to let's say 5-year Treasury or 10-year Treasury?
Yeah, and there's other things that affect that spread. I think all of the things equal, right now they're collecting 65 basis points, call it, in guarantee fees on average. By the way, Ginnie Mae is able to do this. They're all insured, but Ginnie Mae can do this for 6 basis points. And we used to, form Fannie and Freddie securities at 15 and 25 for decades. So I have no idea why. Well, actually, I know why they're at 65 is because there's no competition. The only competition they have is from the private label securities market, right? Who doesn't have the liquidity or the resources and the backing that they do. So I think that when it's all said and done, and not only are they competing with each other, but we can even add other competition, all that's going to do is drive it back down to the guarantee fees that we all used to, I'll use the word enjoy, for the better part of 2 decades, really, until the financial crisis.
And if they were released from conservatorship and did implode again, I mean, the government stepped in once. It was an incredibly profitable exercise for them. It's not like that couldn't happen again. I mean, so.
And part of the NBA's proposal is to have this mortgage insurance fund that a little bit gets paid into. Yep. Kind of, with the Ginnie Mae insurance fund, right? They collected all these premiums. They're supposed to stay at 2%. In terms of ratio, they still never, even during the great collapse of 2008, 2009, 2010, delinquencies through the roof, that fund never went underwater. So it's absolutely possible, in my opinion. It doesn't, and it really could be an explicit guarantee because of the fund as well.
Yeah, a real guarantee, exactly, as opposed to an implied one that, is there's no legal anything around that. So, but that'll be interesting to see. And I don't think anything we'll see in the short term just because of other priorities. But something that's certainly going to be a big topic on this show and in this industry for the next couple of years, most likely. And I think we'll probably get a CFP or a FHFA appointee after the new year, and I think that'll tell us something as well. It's the background of whoever that person is, but yeah, so we'll see how it plays out. So, and in the chat we see Urban Institute implied G fees 67 for Freddie, 64 for Fannie. My shirt is Topps Baseball.
There we go.
Yeah, so
Timeless.
The timeless.
Regardless of administration.
Yeah, exactly. Baseball cards are,
there is always Topps. Yes,
not politicized the sports card market. So, but good stuff.
Well, I hope that both of you are right. I hope that I'm wrong for the industry's sake and for the consumer's sake and for the housing industry's sake. But when things like this happen, now maybe Elon Musk will step in and drive mortgage costs down. Right?
He'll delete Fannie and Freddie.
Yeah, exactly. So I don't know if I can think of a bet, I will.
So Chris, we can't let you leave without just your general thought. Every economist, they're wrong every year. Every single one of them's got the same thing. Rates, slowly going down from 7% to 6.3 by the end of next year. I guess, what's the Chris Bennett mortgage rate projection for
And
20?
by the way, I did notice in the promo that you sent out this morning, you said Chris Bennett's going to predict interest rates for next year. I thought, God dang it, Rich, come on.
Clickbait.
I figured, yeah, if you can tell me what CPI and GDP and unemployment will be for the next year or two, I can tell you what interest rates will be. But I don't know that anybody knows those. So far, nobody seems to. The one thing that I'll say, and I'll try to be quick about this, is people sometimes, and Rob would talk about this in his newsletter sometimes, they have this dichotomy of, well, if all the Fed's expectations are already built into the market, can rates still come down if everything happens as the market expects? And I say, yes, I think they can. And here's the reason why. It's called the Tootsie Roll concept. A couple of people have heard me talk about this. If you think of a mortgage, which is about the same as a 5-year Treasury, being a Tootsie Roll, delicious with all those little different pieces in it, chopped up, so it's based on the expectations for the Fed funds rate every quarter for the next 20 quarters, 5 years. So if the Fed funds rate slowly goes down over time, then what's happening to this Tootsie Roll is every quarter we're chopping off these high rate parts of it. We just chopped off 5 1/4. We chopped off 5, and we're going to chop off 4 3/4 soon. And what we add on to the end of it are parts at the long-term rate, that R-star, actually, if you'll think of it, or the long-term Fed funds rate expectation. So even if everything about what the Fed's expected to do is built into the market, and it is, that doesn't mean that the 5-year Treasury and therefore mortgage rates can't continue to go down slightly if we're actually going to be in an easing cycle. And we are in an easing cycle. It's a matter of how deep is it going to be and how long is it going to be last. So if you're a fan of lower mortgage rates, I do think there is something to be optimistic about. I don't know if it's much more than 50 or 100 basis points come to the end of next year, but again, it's all going to be data dependent, right? We're going to have a lot of really exciting Fed meetings, a lot of exciting CPI reports, non-farm payroll reports. It's a great time to be alive. It's a great time to be a bond dork in mortgage banking.
Not a great time to be a Buckeye fan, but you heard it first. Chris Bennett, 4.99 by the spring buying season.
Wait a second.
So
yes, with 5 points.
If you're going to give him a number, don't give him a date.
I love that, by the way, Rob. I love that.
Well, good stuff. And Chris, as always, greatly appreciate your insight and you coming on the show. And we're going to have you on again soon. And really appreciate you making time coming off a vacation. It had to be a kick in the ass coming back from Arizona to this mess in the Midwest.
It was, yes. Came back to some ice and snow, a little bit of a red face from the sun, but definitely well worth it. Yeah. I tried to be on my best behavior, by the way. I was hoping to be invited back next year, so I hope I complied.
You did. Yeah, it's you should actually be way tougher on me, honestly.
Rich will figure out your next appearance based on the college football schedule that's announced in August, right?
Well, good stuff. And I want to thank all of our attendees for joining us here on the live version. If you're listening on the podcast or watching on YouTube, we do this live every Thursday at 3 p.m. Eastern. And you can go to ChrismanCommentary.com. This is part of the Chrisman Commentary Network. Also, looking for sponsors for the show. Just had a great sponsorship that for the last several shows and a good chance to put your brand in front of a lot of people in the mortgage industry. And if you're interested in that, go to ChrismanCommentary.com or get a hold of Rob or I. And so that's that. And this will show up on Pod and YouTube in the next 15 minutes or so. But Rob, thank you as always.
Thank you, Rich. And thank you, Chris, very much.
Yeah, thank you too so much for having me.
Yeah. And we will see you next Thursday at 3 p.m. Eastern on The Big Picture. Thanks for joining us and have a great rest of your week and the weekend, everyone. Take care.